Welcome to the Deep Dive. Today we're jumping into a stack of sources that reveal something infrastructure investors are starting to call the profound structural dissonance of the late 2025 AI economy.
It's a great term for it. It's really this conflict, this massive conflict that's going to define where, trillions of dollars are headed.
And where they might just disappear.
Exactly. It's a story of two completely contradictory realities that are somehow happening at the same time.
Okay, so on one hand,
You have the financial world, the AI aristocracy, right?
Yes.
The hyperscalers, and they are committing an amount of capital, of CapEx, that is just, it's unprecedented. A wave of money that feels unstoppable.
But on the other hand, that wave of money is colliding with, reality, with immovable physical objects.
Right. The actual capacity of our power grids, the real world limitations of global supply chains. And maybe most importantly, a consumer base whose ability to pay for all this stuff is just collapsing.
And that's the core paradox we're here to unpack for you today. The market seems totally convinced that AI growth is this exponential, inevitable thing.
But it's also actively ignoring the laws of physics and basic economics that are trying to pull it back down to earth.
So our mission today is to try and synthesize these two opposing forces. We're using a unified theory from two key figures in our source material.
Yeah, first is infrastructure investor Zhang Dai, who gives us what he calls the capital perspective, which is all about those physical constraints. And then we have strategist Steve Eisman, who brings the unsparing market pragmatism about the fragile financing and, crucially, the lack of real demand.
And we need to understand why the market seems to be so severely mispricing these two huge risks, the physical risk and the consumer risk.
I think we have to start with the scale, just to frame this. The numbers are almost hard to comprehend.
So the global projected AI capex, it's been revised up again.
It has. We're now looking at something between $2.3 and $2.8 trillion globally, just through 2029.
2.8 trillion. That's the financial mountain.
It is. And that mountain of money needs an even bigger mountain of electricity to power it. In the U.S. alone, the sources are calculating that the current AI path needs an incremental, get this, 47 gigawatts of power capacity.
47 gigawatts. That's the physical wall that $2.8 trillion is about to run into full speed.
Full speed. So you have the trillions on one side hitting a 47 gigawatt wall on the other.
Which sets the stage for the two unpriced risks we're focusing on. First, what the sources call the time value of power, the race to secure actual electrons.
And second, the credit-consumer disconnect, the failure of the revenue engine right down at the retail level.
Let's dive into that physical wall first.
Yeah.
Okay, let's unpack this. When we talk about AI, the conversation is usually about software, algorithms, the models themselves.
The computational side, yeah.
Right, but the sources we're looking at just hammer home this one crucial point. The AI scaling problem in late 2025 is not computational, it's thermodynamic.
It's the ultimate reality check. It really is. For decades, the whole tech industry just coasted on Moore's law.
The predictable doubling of efficiency.
Exactly. And that helped keep the electricity demand, pretty manageable. But the computational intensity of modern large language models, LLMs, it is just completely blown past any of those efficiency gains. We're not getting smarter, we're just using brute force.
We're just building bigger, hotter engines.
And they need exponentially more fuel, which is why that fuel shortage translates directly into this 47 gigawatt deficit just for U.S. AI data centers.
We really need to pause on that number, 47 gigawatts. It just sounds so abstract. We have to contextualize it.
It's essential because when you say, okay, let's go find 47 gigawatts of new reliable power, what are you actually saying? You're talking about the output of roughly 47 new standard-sized nuclear reactors.
47 nuclear power plants.
Yeah. Or, look at it another way, that incremental demand is almost the same as the entire annual electricity consumption of a country like Argentina.
And the U.S. grid just wasn't built for that kind of shock.
Yeah. Not at all. It was designed for decades of really stable, sometimes even declining demand. Now it's facing this sudden vertical surge. It can't absorb it.
And the shock isn't even spread out. It's dangerously concentrated in these latency-critical hubs, right? The places where speed is everything.
Precisely. You're talking about places like Northern Virginia, which is, it's basically the heart of the world's internet.
So they're feeling it first.
They are. We're seeing utility providers there, like Dominion Energy, being forced to just confront this. Their future power orders have jumped astronomically. It's gotten to the point where they had to suspend all new data center connections in huge areas just to manage the existing queue.
Wow. So development is just grinding to a halt.
The gridlock is real, and it gets worse. In some cases, utilities are now being forced to delay the retirement of old, dirty coal plants.
Because they just can't afford to lose a single megawatt.
They cannot. They are desperate for every electron they can get, no matter the source.
But it's not just about the total megawatts. It's about how they're consumed. This idea of a load density shock. What did a traditional data center rack used to need?
So a legacy rack, maybe from, 7, 8 years ago, it needed a manageable amount of power, maybe 10 to 15 kilowatts. You could cool it with basically powerful air conditioning.
And what happens now when you slot in a new cluster of, say, NVIDIA Blackwell GPUs?
That density it explodes. These new high-density liquid-cooled clusters, they push the power demand per rack north of 120 kilowatts, sometimes much higher.
That's a tenfold increase in the same physical footprint.
It's a complete thermal and electrical engineering nightmare. You don't just need more power from the plant miles away. You need to completely overhaul the local distribution system. You need huge new substations, thicker transmission lines, and this complex, closed-loop liquid cooling infrastructure right there on site.
It's like needing a small power plant and an industrial refrigeration system for every single building.
That's a perfect analogy. And all that systemic overhaul means the CapEx, that $2.8 trillion, a huge chunk of it, now has to go to boring stuff like pipes and wiring, not just the flashy silicon.
So if the industry has $2.8 trillion ready to spend, but the physical world has put up this 47-gigawatt wall, the next question is obvious. How are they trying to get over it?
Right. And the sources detail six very concrete, very high-risk strategies. Zingdi analyzes them, and this is pretty much the entire industry's playbook right now.
6 paths. And you said high risk. Why?
Because every single one has a severe bottleneck that isn't about money. It's regulatory, or it's supply chain, or it's purely political. You can't just throw cash at these problems and make them go away faster.
Okay, let's start with what the sources call the fastest path. This is the Bitcoin miner transition.
Yep. Repurposing existing crypto mining sites for AI and high-performance computing workloads.
It seems like a logical jump from securing ledgers to training models, but why is it so strategically important?
It comes back to that fundamental constraint. Access to power. The single most valuable asset in the AI economy of late 2025 is not an H100 GPU. It is a secured interconnection queue position.
They already have a place in line to get power from the grid.
A guaranteed place. Bitcoin miners, especially in places like Texas where the market is deregulated, they spent years and a fortune securing these massive gigawatt-scale grid connections.
So as the economics of just mining Bitcoin get tougher, they're sitting on a golden ticket.
They hold the keys to the kingdom. They have the power hookup. The sources estimate this path could unlock something like 15 gigawatts of capacity in the next 18 to 24 months.
15? That's a third of the entire deficit right there.
It's a massive piece of the puzzle, which is why the hyperscalers are now desperately trying to buy them or partner with them.
But if they're sitting on such a critical asset, why is the market punishing them? You look at companies like Core Scientific or Iron, and they're trading at really weird valuations.
That is the valuation paradox. Many of them are trading at valuations that are actually below the replacement cost of their physical buildings and transformers.
So why the skepticism?
It all comes down to what the sources call the reliability gap. Bitcoin mining is what utilities call an interruptible load.
Meaning they agree to shut down when the grid is under stress, like during a heat wave?
Exactly. They get cheaper electricity in exchange for being able to be switched off.
Hmm.
You cannot do that when you're running a foundational AI training model.
No, you'd lose everything.
Absolutely not.
Ah.
AI training requires 5 nines, uptime 99.999%. If you interrupt a multi-million-dollar trading cycle that's been running for weeks, you risk catastrophic data loss. It's financial ruin.
So investors just don't believe they can make the transition from a dusty shed to a clean room.
That's the core of it. We're talking about converting what are often just massive metal sheds designed for basic airflow into pristine, redundant, climate-controlled Tier 3 or Tier 4 data centers that can handle these incredibly sensitive, liquid-cooled systems.
And that kind of retrofit costs a fortune.
A fortune. Which forces them into these highly dilutive financing strategies, like ATM offerings.
At-the-market offerings.
Right. For anyone listening, that means the company is just continuously selling small blocks of new stock directly into the market to raise cash.
Which constantly pushes the stock price down and dilutes the existing shareholders.
Precisely. Which explains why their valuations stay so low, even though the strategic value of their power assets is, theoretically enormous.
Okay, let's skip to path 3, which strategically seems like the most logical solution. Natural gas.
It really should be. As a baseload solution, it makes the most sense. The U.S. has tons of shale gas. It's the perfect firming power for renewables. It could easily be a 15 to 20 gigawatt solution.
It's dispatchable, it's reliable.
It's the most logical bridge technology for the next decade. The fuel is right there under our feet.
But the bottleneck isn't the fuel, it's the machines that burn the fuel.
That's it. That's the constraint the market completely missed. There is a severe supply chain crisis for utility-scale gas turbines. The manufacturers, we're talking giants like GE, Siemens, Mitsubishi, their production capacity was starved of investment for years.
Why would they underinvest?
Two big reasons. First, you had years of intense ESG pressure and regulatory uncertainty. Everyone was anticipating a rapid shift away from fossil fuels, so they scaled down their factories.
And second,
they are deeply, deeply worried that this AI boom is just a transient bubble.
they're afraid of getting stuck with the bill.
Exactly. They don't want to spend billions expanding factories only to have AI demand slow down in 3 years, leaving them with stranded assets. That fear is now the single biggest factor dictating the pace of the entire AI rollout.
So what are the wait times like now?
They've exploded. We are now seeing quotes of 2 to 4 years for delivery of a new utility-scale turbine.
2 to 4 years. So even if you ordered one today.
That power is not coming online until late 2027, maybe 2028. So this path, with all its potential, is completely bottlenecked for this critical 2025 to 2027 training cycle.
Let's quickly touch on the other domestic alternatives. Path 2 is nuclear, the non-carbon 2047 dream for AI. Why isn't this the immediate answer?
It's the perfect answer for 2035. The sources see a potential of 5 to 15 gigawatts, but the timeline is just brutal. Traditional nuclear plants take a decade or more to build.
What about the new small modular reactors, the SMRs? Weren't they supposed to be faster?
SMRs are hitting what's called the first-of-a-kind wall, FOAK, because they're the first generation of a new design. They face immense regulatory hurdles, new testing protocols, new supply chains.
So all these high-profile deals between tech companies and SMR startups are?
They are effectively long-term call options on power that won't actually be delivered until 2030 at the absolute earliest.
Yeah.
They're completely irrelevant to the immediate 47 gigawatt gap.
Then you have Path 4, the niche path fuel cells, batteries.
A very important but small piece of the puzzle, maybe 2 gigawatts of capacity. They are critical for behind-the-meter deployment.
Meaning right at the data center itself?
Yeah, which helps you get around the utility queue problem. They're great for stability and handling peak loads, but they can't power a whole campus.
Right. The physics just aren't there yet.
No, you can't run a facility that needs constant power for weeks on end just from batteries. They're an essential supplement, not a primary power source.
Which leaves us with the two paths that basically admit the domestic grid has failed. Path 5 is offshoring.
The geopolitical path.
Yeah.
If the U.S. grid is full, the compute has to move. And that's already happening.
Where's it going?
We're seeing massive capital flight to places with cheap available power, often hydropower. Places like Johor in Malaysia or Singapore, Brazil. The hyperscalers simply cannot wait 4 years for a turbine.
And what's the risk there? Building America's AI future on foreign power grids.
It creates this really dangerous data sovereignty paradox. If your most advanced AI models are being trained on servers in Southeast Asia, you introduce geopolitical risk, security risks, latency issues. The U.S. government is getting very nervous about this.
And that brings us to the final path, Path 6, the forbidden path, the diesel option.
This is the emergency brake on the whole system. By law, every data center has to have a massive array of diesel backup generators.
For emergencies.
Right. And the sources estimate that the total installed capacity of these generators across the country is roughly 80 gigawatts.
80. That's almost double the entire deficit.
It is. The power is already sitting there, installed and ready to go. It's just forbidden from running continuously because of EPA emissions regulations.
They can only run them for, what, 100 hours a year or something?
Something like that, yeah. But if those regulations were waived, even temporarily, if they were allowed to run for, say, 500 or 1,000 hours a year, you would instantly bridge the entire 47 gigawatt gap. The problem would be solved overnight.
So the power is there, it's just locked away by a political decision. What could possibly unlock it?
Only one thing, according to the analysts: existential national security. The administration would have to come out and say, we're losing the AI race to China, and declare a kind of technological emergency. Only that would create the political cover to grant waivers and bypass the environmental resistance.
It's just staggering when you lay it all out. The three most promising near-term solutions, converting miners, installing turbines, and flipping a switch on diesel generators, are all blocked by things money can't buy.
That's the time value of power risk in a nutshell. Capital cannot instantly purchase electrons. The AI timeline is now completely chained to the energy timeline, and the energy timeline moves very, very slowly.
The physical world is just saying stop, but the financial world is screaming faster. Let's talk about the money that's hitting this wall, that CapEx forecast. 2.3 to 2.8 trillion by 2029. We have to look at the fragility of that capital mountain.
The scale is one thing, but the unit economics are what's really concerning. The sources break it down. To build just a single gigawatt of AI-ready data center capacity.
1 gigawatt.
Yeah. That costs about $50 billion in total investment. That's the real estate, the power infrastructure, and of course the hardware.
And the risk profile here is all about something called the duration mismatch. This is where financing gets dangerous.
This is the critical point of fragility. When you build a classic piece of infrastructure like a bridge or a dam, it lasts for 30, 50 years. You can finance that with long-term debt.
But AI infrastructure isn't like that.
Not at all. The cost is dominated by the hardware, the GPUs, the networking gear. That's 60 to 80% of that $50 billion investment. So maybe 35 to 41 billion per gigawatt is spent on assets with a useful life of maybe 3 to 5 years before they're obsolete.
So you're financing an asset that lasts 5 years with debt that's structured to be paid back over 10 or 15 years.
And that's the mismatch. What happens if the upgrade cycle gets even faster and that multi-billion-dollar cluster is obsolete in 2 years? The debt is still there, but the revenue-generating potential of the hardware has vanished.
You're immediately underwater.
Instantly.
Yeah.
This creates a massive solvency issue and forces this constant rapid reinvestment, which puts enormous strain on cash and leads to some very creative and very opaque financing methods.
Okay, let's trace that evolution. Stage 1 was simple, right? Investment-grade debt.
Correct. The big guys, Google, Microsoft, Amazon, they just use their amazing credit ratings and cash flow from their legacy businesses to issue corporate bonds. But even they are starting to see their leverage ratios tick up. Their capacity for traditional funding is getting strained.
And when that happens, we get to stage 2, asset-backed securities, ABS. This is where the echoes of 2008 start to get really loud.
This is how you get the debt off your books. You create something called a special purpose vehicle, or SPV. It's a separate legal entity designed specifically to hold these risky assets.
So the SPV buys the GPUs.
Exactly. The SPV buys the hardware. Then it leases that hardware to the actual AI operators and the future rental income from that lease. That's the key. That promised stream of payments is then packaged up into an asset-backed security or sometimes a more complex CDO.
And who buys these packaged up debt products?
Institutional investors, pension funds, insurance companies. Anyone looking for what they think is a safe, yield-bearing asset. The risk has been transferred from the tech company to the bond market.
I have to stop you. This sounds exactly like the mortgage crisis. Instead of relying on a homeowner to pay their mortgage, you're relying on an AI company to generate profits from a technology that isn't fully monetized yet.
That is the structural parallel Steve Eisman is screaming about. The entire structure is built on the assumption of guaranteed exponential AI revenue.
Wow.
If the killer apps don't show up, the AI operators can't make their lease payments, the cash flow stops, and the ABS structures face default. The bond market thinks it's buying a safe asset, but it's actually making a highly speculative bet on the commercialization of AI.
And stage 3, the final layer.
Sovereign entanglement. This is the political backstop. The biggest players frame their expansion as a matter of national security, essential for competing with China. This helps them secure implicit government guarantees, which ensures capital keeps flowing, and it creates this too-big-to-fail dynamic for the AI aristocracy.
So let's see how this plays out in the real world for a company that isn't Microsoft. The sources use Oracle as the perfect case study, the canary in the coal mine.
Oracle is the stress test for every Tier 2 player trying to keep up. They knew they had to spend big, but they didn't have the cash cushion of their competitors, so they had to rely on aggressive leverage, on debt, to fund their AI cloud build-out.
And that's run them straight into a $100 billion debt wall.
It's a phenomenal number. Their total debt crossed the $100 billion threshold after a big $18 billion bond sale just for AI capacity. They have maxed out the credit card to stay in the game.
But wait, if AI is growing so fast, shouldn't they be able to handle that debt? Why is Eisman so bearish on them specifically?
Because of the environment. This higher-for-longer interest rate world is what breaks the weaker players first. Oracle's leverage is now approaching 4 times their EBITDA. That's a huge red flag.
A level of debt that's only manageable if interest rates are at 0 and growth is a sure thing.
And neither of those is true anymore. The cost of carrying that debt is becoming punitive. As a result, the rating agencies, Moody's and S&P, have given them a negative outlook, pushing them dangerously close to junk bond status.
And the market reacted.
The stock plummeted 33% from its highs. It's the perfect proof of the thesis. Growth funded by the credit card is just not sustainable when the cost of capital is high and the return on that investment is still completely theoretical.
And yet, despite the strain we see at places like Oracle, the undisputed king, NVIDIA, just keeps posting these unbelievable numbers. Q3 of 2025, another huge beat on revenue and earnings.
The numbers were absolutely flawless. But here's the subtle signal that the market is starting to cool. After that perfect report, the stock actually dropped 3%.
Perfection is no longer enough.
That's the new narrative. The market is now asking, okay, but where does the next $100 billion in revenue come from?
And NVIDIA isn't just waiting for an answer. They're engineering the demand themselves with what the sources call the anchor fish strategy.
This is their genius move to keep the hardware scaling cycle going. NVIDIA takes equity stakes in the leading foundation model companies, the anchor fish, like OpenAI or Anthropic. This creates a closed, self-reinforcing loop.
Walk me through that loop.
Okay, so the foundation models raise billions of dollars. Some of that capital comes directly from NVIDIA. The condition, whether it's explicit or implicit, is that a huge chunk of that new capital has to be spent immediately on buying the next generation of NVIDIA GPUs.
So NVIDIA's investment comes right back to them as revenue.
Instantly. NVIDIA gets the profit, the model gets more powerful, and then every single one of their competitors has to buy even more NVIDIA gear just to keep up. It's an engineered demand cycle controlled by the hardware supplier.
And this consolidation is now extending to their oldest rival. We saw the surprising development in late 2025, the Intel-NVIDIA axis. That sounds like a truce.
It's a defensive consolidation driven by geopolitics and physical necessity. NVIDIA agreed to invest $5 billion into Intel. That was immediately followed by $5.7 billion in U.S. government funding for Intel. This is a state-backed alliance.
Why does NVIDIA need Intel all of a sudden?
NVIDIA needs Intel's domestic foundries, their factories, to secure their supply chain against instability. Intel, meanwhile, needs the capital and accepts a junior partner role just to survive. This axis centralizes the whole value chain and cements the high-cost structure of the AI build-out for everyone.
So the price of the tracks is being locked in at a high level, which brings us right back to Steve Eisman's historical warning, the railroad analogy.
Eisman says this moment is a direct echo of the post-Civil War railroad boom. The parallel is perfect.
Yep.
Back then, huge capital was spent building immense capacity, thousands of miles of railroad tracks.
But the capacity massively outstripped the actual profitable demand.
Exactly. And most of those railroad stocks eventually went to zero. There were too many tracks chasing too few paying customers. Eisman's warning today is that simple. The market is buying the tracks, the GPUs, the data centers. But the trains, the profitable, large-scale killer apps that generate new revenue, are still mostly missing.
So AI is a tool, not a miracle.
For now, it's mostly a very powerful productivity enhancer,
Yeah.
a better search engine, a smarter way to write an email. It's a great upgrade to Google. But that doesn't create the massive new market needed to justify a $2.8 trillion spend. And if that ROI stays theoretical, the fragile credit structures, the ABS, the Oracle debt, eventually they will snap.
And this is the final piece of the puzzle, the ultimate connection. Every single dollar of AI revenue at the end of the day has to come from the consumer's wallet. And the sources are clear. The consumer engine is stalling out hard.
This is the credit-consumer disconnect. The B2B infrastructure world thinks it's in a boom, but the B2C economy on the ground is flashing bright red recession signals. And the consumer is the center of gravity. If it collapses, it pulls everything else down with it.
And the November 2025 earnings reports gave us the perfect picture of this with the tale of two retailers, Target versus Walmart.
It's the clearest stress test you could ask for. Look at Target, the discretionary victim. Stock is down 39% year-to-date. Sales are declining. Why? Because they sell discretionary goods, home decor, electronics, new clothes. The middle-class consumer's excess spending power for wants has evaporated.
And at the same time, Walmart, the value haven, posts a robust 6% revenue growth.
And this is Eisman's crucial interpretation. He doesn't see Walmart's strength as a sign of a healthy economy. He sees it as a clear sign of consumer stress.
People are trading down.
They are trading down. Upper-middle-income shoppers who used to go to Whole Foods are now at Walmart to stretch their paycheck. It's a flight to value, driven by necessity.
And that budget pressure is structural. It's being driven by the frozen housing market, this housing lock-in effect.
This is a huge structural paralysis in the economy. Millions of homeowners locked in mortgage rates of 3%, maybe 4% during the pandemic. Today's rates are over 6%.
They're trapped. They can't afford to move.
Exactly. Selling their house and buying a similar one would add thousands of dollars to their monthly payment. They can't do it, so nobody is moving. The inventory of homes for sale has collapsed.
And the economic fallout from that goes way beyond real estate.
It kills the entire housing turnover economy. Retailers like Home Depot and Lowe's are lowering their guidance because if people aren't moving, they aren't doing big renovations. But even more importantly, it kills the wealth effect.
That feeling of confidence you get from your house value going up.
Right. Homeowners are wealthier on paper, but because they can't sell, that equity is totally illiquid. They are house rich and cash poor.
Let's bring this all the way back. How does a cash-strapped, locked-in homeowner connect to the $2.8 trillion AI investment?
It is the ultimate Achilles heel. The entire monetization plan for the hyperscalers relies on subscriptions. A $15 or $20 a month fee for an AI-enhanced operating system, an AI video tool, whatever it is.
Right.
But if that consumer is so strained that they're choosing Walmart over Target, that marginal $20 a month subscription is one of the first things to get cut.
They'll churn.
They will churn, or they won't even sign up in the first place.
Right.
And if the end consumer won't pay, then the enterprise software companies, Microsoft, Adobe, will see their projections falter. And that will lead to a collapse in demand for the underlying infrastructure. The consumer's inability to afford discretionary goods today is the single best leading indicator of a future AI infrastructure glut.
So this whole deep dive really comes down to a race against two different clocks, two existential clocks that the market is just not reconciling.
That's it, exactly.
Yeah.
First, there's the physical clock. Can the industry, using those 6 messy bottlenecked paths, actually secure the 47 gigawatts of power before the capital markets lose patience with all the delays?
And then there's the economic clock. Can the AI world develop truly profitable killer apps before the debt-laden companies like Oracle, with its $100 billion debt wall, buckle under high interest rates and a consumer recession?
So let's try to summarize the key takeaways for you, our listeners, based on what we're seeing from Zing Dai and Steve Eisman.
First, it seems infrastructure alpha is found in the dirt, not just in the code.
Yes. The most resilient value here isn't in the silicon, which becomes obsolete so quickly, it's in the physical layer. Power plants, natural gas turbines, and especially land that already has secured interconnection rights. Those transitioning Bitcoin miners, for all their faults, hold an incredibly valuable strategic asset.
Second takeaway, beware the credit card capex.
You have to monitor these highly leveraged Tier 2 players. Oracle is the poster child for this vulnerability. Financing short-term assets with long-term debt in a high-rate environment is a recipe for disaster. Their debt wall is structurally fragile.
Third, and maybe most important, the real crash indicator is the consumer's wallet.
Forget the B2B hype for a second. The real leading indicators are coming from Target's stock price, the frozen housing market, the flight to Walmart. A deep consumer recession means the revenue that's supposed to support that $2.8 trillion investment is purely imaginary.
And finally, the end game appears to be sovereign consolidation.
Right. That defensive alliance between NVIDIA and Intel, backed by government money and framed as a national security issue, that shows a flight to resilience over pure efficiency. It's becoming a too-big-to-fail game, increasingly intertwined with geopolitical goals.
The analogy you used earlier seems perfect. The bridge to the AI future is being built with trillions in fragile debt. But the toll to cross it is rising, the foundation is shaky because the power isn't there, and the commuters, the consumers, are running out of gas.
And that leaves the one profound question for 2026. What happens when the $2.3 trillion bill comes due, but the lights literally go out because the physical reality of the 47 gigawatt deficit was ignored all along?
A truly compelling and, frankly, unnerving analysis. Thank you for joining us on this deep dive into the contradictions shaping the future of AI.
Of course. And to help you track this total market temperature, to monitor these risks of overvaluation we've been talking about, we want to remind you that you can search for and download the iOS app Buffett Indicator from the Apple App Store. It's a great tool for monitoring market bubbles and sentiment in real time.
And if you found this discussion compelling and want to hear our full extended analysis on these topics or get access to even more advanced content, please consider joining our Deep Value Club membership. You can also subscribe to us on Apple and Spotify podcasts. Just search for Deep Value Investing.
And as always, our necessary disclaimer. All the analysis we've presented is based on publicly available sources and is for educational purposes only. It is not investment advice. Please always conduct your own comprehensive due diligence before making any investment decisions.
We'll catch you on the next deep dive.
Sign off.